right, I'll call the meeting to order.
Good morning. I'll go ahead and do our roll call. Landon Moore,
Present.
Mark Gardner, Stephanie Elliott Williams, David Holly,
Here.
Stephen Carter, Gregory Coleman, Jeanette Fernandez, here, Trey Burke,
Here.
Kimberly Sinclair,
Present.
Derek Challenger,
Here.
okay, then Councilman William Dodson, Perry Wilkes,
Here.
John Morrison, Brian Birnbaum,
Here.
Jim Whitney. Okay. All right, and we
Hopefully
do
he'll
not.
be here in a few minutes.
Okay, and we do not have a quorum.
Okay, with that, I'll go ahead and turn it over to Trey to make introductions to a couple new staff members.
So we have, as the chair noted, we have two new staff members on the board. We have Miss Kim Sinclair, the new HR director, joins us. How long did you get into the city? When did you join the city?
Oh, that was in June.
Back in June. And then we have Miss Fernandez, who's been here since Monday. So we'll be catching both
Day
of
four.
them. So we'll be catching both of them up. Would you like to say anything before we start, or?
Just coming with years of experience, HR, compliance, benefits, employee relations. Glad to be here.
Good to have you.
Thank you. My name is Jeanette Fernandez. Like he said, I will be the new CFO for the city. I've come again with 15 years as a public servant, 10 of which were in budget and financial management. And I'm new to the city, so if you have any recommendations for food or fun, super open to that.
Well, the fun is talking about the pension. So you start on Monday, hit the ground running, and top of the priority list is the retirement plan.
Sounds like a good time to me. So.
But okay, great. I guess we don't have minutes to approve because we don't have a quorum. Before getting into the presentations by Greystone and John Hancock, we have one item to cover, which is a quick update on the OPEB.
So it looks like it actually was pretty far down, but this was kind of a monthly snapshot. So I'm wondering if it might have been that hit that we saw a few weeks ago. But yeah, it looks like it was actually down pretty substantially at the end of the end of the last year, at the end of June. So I'll circle back on that and also send a report to the board on where exactly we stand. I'm hoping it's just something in the numbers that they sent out in their statements. They haven't sent like a full year-end recap. I just have the last monthly report, so I'll circle back.
The 1 month is down?
No, the year is, but I didn't see it in May. Like May, it was still up, but then this month it was like down 2 million.
Does it have the fiscal, or excuse me, the calendar year to date returns?
That's what it was. That's what I'm seeing. So that's why I'm.
Okay. Which is surprising because I believe that portfolio is roughly a 70-30 mix of, similar to actually the retirement plan,
Yeah.
of equities and fixed income. And we did have that blip in April where stocks were down considerably post, Liberation Day and the tariff, the tariff thing. But I thought, towards the end of April, May, and June, there was a big recovery. So, $2 million is a pretty substantial hit.
I'm hoping it's a markdown of some sort, like someone valued something or made just an accounting entry, and that may come and go. That's what I'm hoping. But I'll talk to George more.
Is there any way we can tack that down if that indeed what it was, or?
Yeah, I'll let everyone. I'll report back.
Because what is it? The city or the balance was around 8 million-ish at the beginning of the year.
Yeah. So no, it was 11 million.
So it went from 11 to 9.
Yeah.
Okay, that is substantial.
Yeah. But again, it could have been how they're accounting for things or how they're marking stuff down. they don't give a ton of detail on these, on the month reports. It's pretty much just A plus B plus C, and then at the end. So I'm hoping there's some detail they're not providing in one of those.
Because we're not using any of that fund to pay benefits.
No.
That's
Well-
just the city's paying benefits, but also funding this to cover, I guess, future
Yes.
benefits if and when the city chooses to use the fund to pay benefits. Okay. Yeah, I'd definitely be interested in figuring out what's going on with that, because that's
And we should be getting the full report on the year in the next probably 30 days.
Does that fund, I guess that is a like a state entity, I think, that, or some sort of quasi-government thing that
There we go. Yeah.
covers or runs that portfolio. So are they on the June fiscal year thing, like
The June beginning or ending?
ending? Is it
Ending, yeah.
Okay. All right. Well, it'll be whenever you get more information, please let us know. With that, we have next on the agenda, we've got Greystone. We have Jim.
Yep, sorry. Teams devils us at Morgan Stanley, our firewalls.
Change the roll call. Jim is here.
Okay.
Present. Great to see you all. Hope you're having a good summer.
All right.
So Jim, maybe I'll go and kind of talk about the portfolio, and then we can sort of go through the other slides on the outlook. Is that?
Yeah, that's fine. We can take questions as we go.
Yeah, perfect. Okay. Well, thanks everyone. Appreciate the opportunity to be with you today virtually. We look forward to seeing everybody in person next time. I put together this executive summary just to sort of consolidate a lot of the information that's housed in the bigger performance report. We still sent that out, but I think maybe the shorter version, more concise with a little bit more sort of clarity will help guide our discussion and help frame how the portfolio is doing relative to a number of different performance measures. On slide 3, Stacy, there's just some text there. I'm going to kind of skip over this, and if you haven't read it, you can read it at your leisure. But on page 4, we just kind of go through the returns of the major capital markets over the second quarter, year-to-date period, and then longer periods, 1 and 3 years. And Landon, just to kind of follow up on some of the comments you made about some challenges in the early part of April, and then the market recovering. It's almost like another Rip Van Winkle market, and we seem to have a lot of these where if you just look at the return for the quarter, up 11% on the S&P 500, up more than that in non-U.S. equity markets, you would think that there was nothing to see here, nothing to worry about. In fact, it couldn't sort of be further from the truth in terms of the way the second quarter played out. We finished the second quarter in a very different place than where we started. And if you'll recall, into March and the early part of April, it was really the first week of April where reciprocal tariffs were disclosed, and those tariffs assessed on various countries around the globe being higher than the worst case scenario of what anybody thought was possible. That sent the market into a pretty drastic decline. And in fact, we touched briefly a point where from the highs that we had in the equity markets, at least in this country, in February to the point where we ended, where the market troughed, which was on April 7th. We briefly touched a 20% decline from that high to the low. That is the technical definition of a bear market. So we entered bear market territory ever so briefly. And then the market reversed course rather dramatically. And in fact, from the intraday low on April 7th to where we ended the second quarter, the S&P 500 was up about 31%. So we had a 20% decline, and then we had a subsequent rally of about 30%. So nothing, as I said, nothing to see here couldn't be further from the truth. And the reason that the market rallied so strongly was because it was clear that the tariffs that were put in place that everybody was concerned about was going to have significant impact on the rate of inflation and a slowing of the global economy were used by and large to negotiate and to extract concessions from various countries around the globe. And so those tariffs were rolled back, goods were excluded from those tariffs, and so the market began to understand more clearly, I think, that tariffs were not here forever, and certainly the magnitude that they were originally put on were not here forever. But they were going to come down to a more appropriate and acceptable level to what the market had originally thought was going to be the case. And so that's why we saw such a strong rally risk on in the second quarter. Again, 11% return on the S&P 500, a little bit lower in the Russell 2000. For the first time in a really long time, non-US stocks have outperformed the US equity market, up about 12% in the second quarter, and you can see year to date up almost 20% on the EFA index, up 15% in emerging markets. A significant portion of those, in some cases, eye-popping returns are a function of the fact that the value of the dollar declined fairly significantly in the first half of this year. And in fact, in the first 6 months of this year, the US dollar's value relative to other foreign currencies was down about 12%. That's the worst performance for the US dollar in about 50 years. And anytime we've got assets that are invested overseas and currencies that are not the US dollar and the value of the dollar falls, we earn extra returns as a result of that. If you stripped out the impact of the falling dollar on non-US equity market returns, you'd find, at least over the year-to-date period, they're much more in line with the returns that we saw in the US equity market, up 6% on the S&P 500. Bonds were fine. They were okay. We earned our yield effectively off of the bond portfolio. Interest rates have been relatively stable. They go up some days, they come down, other days. But by and large, interest rates have been relatively stable as inflation readings, particularly in the early part of this year, have started to come down. We've seen, in some cases, sort of a bottoming of declines in inflation. We haven't gotten to the point where the Fed is comfortable in cutting, although with the last jobs report that was released last Friday, the expectation in the market now is the Fed is going to cut at least two times. It's sort of a coin toss for a third cut before the end of the year. There's virtual certainty in the market, and I'm talking about the market. This is not necessarily Morgan Stanley's view, by the way. Virtual certainty in the market that we're going to have a 25 basis point rate cut in September, another one in October, and it's really a coin toss of whether the market expects that third rate cut in December or not. Our view, and I'm not going to steal any of Jim's thunder here, but our view is that we expect to see sort of a reacceleration of inflation, and in light of that, it's going to be really hard for the Fed to cut interest rates this year. Next year's a different story if the economy continues to slow, but at this point, we think it's going to be really tough for the Fed to go along with the market's expectations here because of its concern around inflation and inflation not being at its 2% target. Any questions about that? I know Jim will walk through more detail in terms of the outlook, but any questions about capital market returns before we get into the portfolio? No. Okay. Let's go to the next slide if we could, Stacy, slide 5. This is just a quick snapshot of the value of the plans at the top of the page here. We ended calendar year 2024 with about $187 million in assets. You can see values declined in the first quarter of this year as a result of a little bit of softness in equity markets in particular. And then with the strong rally that we experienced in the second quarter, value of the portfolio back up to about $194 million at the end of June. On the bottom right-hand side, in terms of our exposures and how we're allocated, as you know, we've got a 70% target to equities, 22% target to bonds, and an 8% to alternatives, which for all intents and purposes is sort of core real estate and a little bit of hedge fund exposure. We're slightly overweight at the end of June to stocks, about 1.5 points overweight, and carrying a little bit of cash from the city's contribution. So that is just kind of parked in a money market fund to pay fund expenses and benefit payments each month. That number will come down over time. And then, of course, a corresponding underweight to bonds and a little bit of an underweight to alternatives. So for all intents and purposes, a little bit underweight bonds, kind of basically right on target in terms of our 70% equity allocation. And the over and underweights, by the way, across these different asset classes are well within the ranges that are specified in the investment policy statement. If we looked at our equity portfolio, that's at the table on the right-hand side. How are we positioned? How are we structured? The benchmark is the column on the right-hand side. This is, by the way, the new benchmark that was adopted at the end of last year, which is the MSCI All Country World Investable Market Index. You can see how, though, the benchmark is allocated across the different categories of global stocks. We're slightly overweight large cap U.S. stocks, and that's been historically that's been a good place to be. So far this year, as we talked about earlier, because of the decline in the dollar, non-U.S. stocks have actually outperformed again the first time in a long time. We've seen a little bit of a catch-up trade, by the way, in the early part of the third quarter here, where U.S. stocks are once again starting to outperform non-U.S. stocks. But we're a little bit overweight large cap, a little bit underweight small cap here in the U.S., and then a little bit underweight developed non-U.S. equity markets relative to that benchmark. Any questions about that? Okay, let's go ahead to slide 6 if we could. Stacy, thank you. Here are the net of fee results. We're up about 7% in the second quarter. That's lagging our benchmark of about 8.5%. So, disappointing results relative to the benchmark. That is now dragging down the year-to-date return relative to the benchmark. We outperformed by about 50 or 60 basis points in the first quarter of this year. The second quarter, because of our a little bit of defensive positioning, which we'll talk about in a few minutes, dragging down the second quarter result, which is which is bringing down the year-to-date return. Since inception, because of the sort of the past couple of plan years of underperformance, given the portfolio positioning and the strength in the equity markets, is contributing to some of that, or a lot of that since inception return lagging the benchmark. We'll talk more about the reasons for that in a second, but if we can go to the next slide. This is a slide that we show to the City Council on a regular basis when we get together. I think it's November each year. And what we're showing here are the plan year returns. So the 12-month returns ending June 30 of each of these years that are listed on the left-hand side here. And as you know, the actuary uses a 7.25% assumed rate of return to do all its work in terms of valuation and forecast of funded status, et cetera. So the objective is to earn, of the portfolio, is to earn a long-term return of at least 7.25%. It doesn't mean it's going to happen every year, but over long periods of time, we and you would certainly expect that to be the case, because to the extent that we're able to generate returns in excess of 7.25%, that means the ultimate cost and contributions required by the city will be less than what the actuary is forecasting. You can see over the recent 3 years in particular, the 3 plan years, double-digit positive returns, well in excess of 7.25%, and that includes the fiscal year that just ended June 30th of 2025, up 11% net of fees. But there are some periods like 2022 or going all the way back to the plan year 2015, where returns in some cases were dramatically below the 7.25%. Importantly for us, when you look over the long period of time, since we've had discretion on this portfolio, which goes back to the fall of 2018, on the bottom of that slide, 8.2% compound annual return, about a full percentage point higher than the assumed rate of return. So again, that is ultimately reducing the cost of the pension plan to the city. And then even going all the way back to 2012, about 7.5%, not quite 7.5%, so still above that 7.25%. So again, it's not going to be every year. This is what we show the City Council, and I think it's sort of relevant here and important to keep in mind that, anything above 7.25% is going to be good for us and good for the city. On the next slide,
can I just make 8. One comment there?
Sorry, go ahead. Yep.
I guess 2 things there. This is a testament to the overall strategy and the asset allocation that this board, and in coordination with Greystone, of the 70-30 mix, a combination of the overall asset allocation being a good strategy and being disciplined, sticking to that strategy, but also pretty good markets over that period as well.
Yeah, for sure. And again, it doesn't mean when markets are weak, like they were in 2022, that we're not going to go down. We are. But as long as we don't shift strategies at inopportune times, like when the market was going down in 2022, and we stick with that 70-30 mix, markets have a tendency to recover, and markets recover in many cases a lot more quickly than any of us think are possible, which is effectively what happened post 2022. We had, and I'm talking calendar years now, but in 2023 and in 2024, we had 2 consecutive years of over 20% returns. As we were living through 2022, it would be tough to find somebody who thought that markets would recover to the extent they did and the speed with which they did. But, markets go up and down. We're going to be exposed to the volatility and the ups and downs of the markets. But, Landon, to your point, the discipline we have in sticking to the policy, even when things don't look great, results in the kinds of returns that have been generated over the long run. Any other questions about that? Okay. I'm going to get to the portfolio in a second, but here's another chart that we've in the past showed the City Council. I don't know if we've showed this to the Retirement Board, but what we're showing here are our actual returns. So you'll see in the table sort of on the bottom of this page something called total plan, and those are our actual returns that have been earned over the various periods here. And then this distribution, these floating bar charts, are the returns earned by other public retirement systems. So as best as we can, it says, well, how are we doing relative to other plans like us, and the nature of the way other public funds invest. And we get this data from an organization called Investment Metrics, so it's not anything that we're calculating. We buy this data, we buy this information. It's one of the leading providers of these kinds of data and information. But they collect information about the returns of various other public funds around the country. They're big statewide plans, they're small municipal plans. It's kind of everything smushed together. And importantly, you'll see, and when you look at that total plan line, by the way, you'll see numbers in parentheses. That's where our return ranked in terms of the percentile relative to the returns earned by other public funds. So if I look at the year-to-date period, and I'm looking at the bottom of that sort of underneath the graph there, our return was 6.84%, and in parentheses is 26. That means we ranked at the 26th percentile. So as we'll talk about in a minute, even though we underperformed our benchmark, we outperformed about 75% of other public retirement systems. So it's not that we're targeting, we're trying to target beating other public funds, but the strategy we've got in place, the discipline with which we implement it, has resulted in many cases in substantially better returns than the returns earned by other public funds. And I think that's an important perspective to keep in mind as well. Now, a lot of that performance difference is going to be generated by the strategy that is implemented by us versus others. The reality is others have an awful lot of their dollars allocated to alternative investments, and by and large, public markets have done substantially better than alternative investments, particularly after you take into account the fees that those plans pay to invest in those asset classes. But even over 3 years, we're beating, 63% of the returns of other public funds. Over 7 years, again, we're beating 75% of other public funds. So again, it's not a goal, it's not an objective, but it's nice to see that, things are working, and relative to others, we have a very, very competitive return. Any questions about that?
I have a couple questions.
Yep.
Well, this is, I guess, good perspective. You always want to see how you're doing against your peers.
Yep.
You said that the biggest, or one of the drivers, I don't know if it's the biggest driver, is our allocation to alternatives relative to the sort of peer set.
Yep. Yep.
I know some of the large retirement systems, thinking of like the state of California, had a large allocation to alternatives, and I think they've been reducing that. Is this sort of weighted by asset size? Because I would think the numbers here would be dominated by a few of the large players, and maybe not representative of necessarily smaller, plans like ours.
Yeah. No, it's a fair point. These are not weighted by asset size, Landon. These are simply the raw data that's reported by each plan. So CalPERS return is reported here, and
so their weighting would be the
Milwaukee's
same.
return.
So
Yeah.
regardless of the plan size, they're sort of equally weighted. California's return counts the same as Portsmouth's return in this.
Correct. So what we're just doing here, simply doing here, is you think about it as sorting. Let's just say there's 100 plans in here. There's more than that, but let's just say there's 100 plans in here, and then we sort the return regardless of asset size, from the highest to the lowest. And so you have that distribution, and then you can create percentiles off of that sort from highest to lowest, and then figure out where our return plots in that distribution. So it's not, CalPERS and its $500 billion in assets, shows up wherever it is they show up. And the city of Milwaukee with its, a couple $1 billion in assets shows up where it shows up. And then Portsmouth with its $200 million in assets shows up exactly where it plots within this distribution. So it's, the returns are not, we're not showing an average return, by the way. And I think that's where it would, where the asset weighting or not would come more into play, Landon, is if we're showing an average return. We're just, showing the different percentiles. So the assets are not as relevant in this metric as it would be in the other.
Okay, that makes sense. Two other quick questions.
Yep.
Do you have data on, broader data on the asset allocation, like just general, like stock bond mix, or like U.S., non-U.S.? Do public plans in the U.S. have a bias towards U.S.?
Yes, there's this notion that's often referred to as home country bias. And that, by the way, that's true around the globe. It's not necessarily a United States thing, but based on wherever the plan is domiciled, you tend to have more of your equity investments in your home country stock market than overseas. So I don't have the specific breakdown of U.S. and non-U.S. landed. I can get it, but most plans are going to be overweight U.S. stocks relative to U.S. stock share of global equity market indices.
So that's helping us over 1 year and shorter periods, but probably hurting us a little bit over the longer periods relative to peers.
Correct, because you're right, we are much more balanced. We're still overweight U.S. stocks, but we're much more balanced in terms of our U.S. non-U.S. mix than what's typical of other public funds.
Okay.
The other thing we don't do, and this is worth mentioning because there's increasingly intense focus on this topic, particularly in the public fund realm. We don't do anything funny, for lack of a better term, or biased when we set our benchmark. Our benchmark is, I'm using round numbers, 70% global equity market index, the broadest representation of global equity markets, and 22%, one of the broadest representations of the U.S. fixed income market, and 8% a broad representation of various alternative asset classes. That is as simple and transparent as it gets. There's a lot of public funds that monkey with the benchmark to make their actual returns look better relative to the benchmark, because in many cases, and this is particularly true with the big public retirement systems, their staffs, CIO, all the way on down to people that are buying stocks and bonds and hiring and firing managers, oftentimes have incentive compensation where if they beat a benchmark, they get paid higher levels of compensation. And it wouldn't surprise you to learn that there's a lot of manipulation to make that benchmark as slow a rabbit as possible so that staffs can maximize their incentive compensation. We don't do it, we don't have it. Ours is completely and totally transparent, which is why a chart like this that's on page 8, which gets rid of the benchmark completely and just says, how did I do relative to others? And by all measures, over every period of time, really with the exception of the 5-year return here, we are in the top half of the distribution. So we're better than even after you get rid of the nonsense sometimes that goes on with benchmarks. We're in the top half of the distribution, and in some cases we're in the top 25% of the distribution. And this is becoming increasingly to light. Just recently, I think it was last week, the state of Iowa, there's a whistleblower at the state of Iowa that's alleging just this. So there's increasing focus and scrutiny on the way that public funds set benchmarks, and I can just assure you that there's nothing that we're doing on our side that is making the benchmark a slow rabbit, and you would see that from the fact that we underperformed over the last couple of years. So again, I just wanted to get that out there and just make it crystal clear that there's no manipulation of the benchmarks on our end, which is again an issue that's getting focused on in this sector. Any questions on that before I get into the manager side? Okay, let's go to slide 9. This is the last one, and then I'm going to turn it over to Jim. So you saw that we underperformed in the second quarter. We underperformed by about 1.7 percentage points, which is dragging the return for the year-to-date period now below benchmark as well. There's really 2 reasons in the second quarter that caused that underperformance. The first one is that we talked about we're overweight U.S. stocks relative to non-U.S. stocks, and this is the first time in a long time that the non-U.S. equity markets have outperformed the U.S. equity market. So that's contributing a little bit of the underperformance, but the bigger issue is that we've had some active managers on the equity side that have underperformed, and in some cases underperformed fairly dramatically. And if I could boil the underperformance at the active manager level down to one issue, it's defensive positioning in their portfolios, and I'm going to come back to that in a second. We have, as a percentage of our total equity exposure, 35% of our total equities are actively managed. So 65% is in passive. So the market's up, that passive exposure, when the market's up 10, we're going to be up 10. When the market's down 12, we're going to be down 12. But we have active management in the portfolio because over long periods of time, we believe that these active managers in particular are going to be able to generate returns greater than what's provided in the broader equity markets. And again, we've only got about a third of the portfolio, a little more than a third of the portfolio equities in actively managed strategies. What we're showing on this slide is the active managers that we have in the portfolio. In the public markets, we're not showing the alternative side. Next quarter, we're going to do a deep dive into the performance of the alternative side. And I can say by and large, the alternative, I'll just kind of give you just a quick headline. The alternative side is actually doing okay, particularly relative to bonds, which is how we think about that exposure. But you can see here on the active side, there's a few managers that have underperformed, and in some cases underperformed fairly dramatically. Two of them that stick out to us, they're both actually the same firm. So GQG, Emerging Markets, you can see they were up 5.3% versus 12 in the second quarter. They're up 5% versus 15 year to date. And then on the global equity side, GQG up only a little more than 1% versus 11.5 for the second quarter. Flat to slightly down year to date, up 16% on the index. So let me talk first about the emerging market side, then I'm going to come to the global side. If we could boil down, and we boiled down GQG's emerging market underperformance to pretty much one singular issue, and that is its exposure to India. And I wrote some things down, and I just want to kind of give you this information. India currently is in the crosshairs of the tariff war with the United States. What the United States is looking for is to get India to stop buying Russian crude oil. And so India's been hesitant on doing that. And so India's been one of the worst performing equity markets across the emerging market complex. GQG's got about a 2x weight to emerging markets, to India. They're about 35%, and the index about 17%. For the quarter, India was down 12. Underperformed the broad emerging market index by 12 percentage points. Year to date, they underperformed. That country has underperformed the broad index level by 15 percentage points. So that 2x underweight has significantly hurt their performance relative to the benchmark and accounts for a good chunk of that. In addition to that exposure, GQG's got exposure within India to a sort of broad array of stocks that have been charged by the New York, I think it's New York, Attorney General of engaging in bribery schemes. These are real companies that have real revenues, but the allegations are ones of bribery for some solar contract within India, not within the United States, but within India. The company vigorously denies those allegations, but those stocks, and they happen to be the biggest exposure within this portfolio in terms of their India exposure, were hit very, very hard as a result of that. We've seen those stocks start to recover, but India in general continues to be weak. So it's really, the underperformance here boils down to India exposure, the allocation relative to the market, as well as the stocks within India that were owned there. On the global side, and I'm happy to answer any questions, but let me just spend a couple of minutes on the global side. One of the reasons why we added this global equity allocation to the portfolio, and this goes back to the middle of last year, middle of 2024, was because we viewed our equity portfolio has a lot of beta. And what that means is we have a lot of passive exposure, which we talked about. 65% of the portfolio is allocated to not to active managers, but to passive index funds. And if markets were to experience another 2022, or when they do experience another 2022, we wanted something in the portfolio that was going to be a bit more defensive. And that was the whole reason behind this global equity allocation. It has a lot of defensive characteristics, and in particular when markets are soft or declining or kind of going sideways, this portfolio tends to do really well. And it did do really well in the first quarter of 2025. We outperformed by about 50 or 60 basis points. At the total fund level, this portfolio did even better than that. But with the market that's rallied so strongly from those April 7th lows to close the second quarter up, in some cases, double digits, that defensive posture of this portfolio means this portfolio didn't nearly keep up when the equity markets were running. In fact, you can see that. And so we like that defensive characteristic. We want that protection in the portfolio because over long periods of time, if we can go down less than the market when the market goes down, that means we don't have to recover as much to get back to break even. So we like that feature, and this is how we build portfolios across all of our clients, of doing better when markets are weak. And so we feel we're not surprised by the underperformance. I was going to say we feel good. Nobody feels good when we're underperforming. Or when the manager's underperforming by 16 percentage points over the year-to-date period. But we're not surprised by it given what's going on with equities. And in fact, if you looked at from the April 7th lows to the end of the second quarter, it's the real speculative stuff that is driving the market. Bitcoin was up 112% from April 7th through the end of the second quarter. Not something that we invest in, but it gives you a sense of what's driving the market. Unprofitable technology companies are up 60%. So it's really this low quality, speculative names, which is very different than the purpose of this portfolio and the role it plays in our overall allocation. So again, nobody's happy with this, but we understand it given what's going on in the market. And again, we've got 65% of our portfolio, our equity portfolio, and passive investments that go up and down exactly with what's going on in the market. So with that, I'm going to stop. See if there's any question. I'm happy to talk about any of these firms, but I just wanted to call those two out in particular because certainly they stand out.
Both of those, the GQG, definitely kind of jumps off the page.
Yep.
Is that a manager you just added this year?
No, we've here's the unfortunate part, Landon. We've been investing with these managers for a long period of time. On the emerging market side, I'm going to say 10 years. On the global side, it's a bit more recent, probably over the last, 3 years or so. You look at the long-term track record of these firms, even on the emerging market side, they're through the roof. On even the global side, they do really, really well. The timing of our investment, which is basically the last 12 months, not great, right? Because the markets have been so strong over that period of time.
But the global equity, the year to date and the since inception's the same.
Correct. Yes. It's so our inception was June of 2024. Yep. For Portsmouth, we've been investing with.
Oh, this is year to date of the fiscal year, not the calendar year.
No, this is the No, this is the calendar year.
Fiscal year, huh?
Yeah, I'd have to. I'm sorry about that. Let me check one thing. Give me 1 second. You're right. I didn't notice that. I'm sorry. That doesn't seem right since inception. But I'll go to the bigger book and confirm. Or give me a second. No, okay, sorry. Wait, what did I do here? Hang on, give me 1 second. So the calendar year-to-date return for the global equity portfolio should be up 2% versus up 10.1% for the benchmark. Sorry, so the calendar year-to-date number that we have on this slide is not right. I'll get that changed. The since inception return is, and the since inception return is a 1-year return.
Okay, so both of them are about a 1-year return? The emerging markets and
emerging markets, yes, is a 1-year return as well.
Can you put that in perspective a little bit more as far as, I mean, that's, I don't recall seeing any manager underperform by 20% in 1 year. How do you think about that in terms of just the universe of managers? How that's
it's a fair point, and relative to the tracking error, Landon, it's like a 2 or a 3 standard deviation event. I mean, to say this is an outlier is an understatement. I mean, it's really an outlier. This is just, hasn't happened in the past. They've had big drawdowns in the past. And it's really around those periods where it's the low quality stuff in the index is driving the return. The issue with the emerging markets has been around India, and almost exclusively India, both with the allocation and the stocks in there. But you're absolutely right. It's an outsized result, but in some ways it's explainable. It's not like they've taken exposures in their portfolio that are different than what they've historically done. They've made big bets in certain areas in the past, and some of them have worked, and some of them haven't. It's really this double whammy of the stocks that they own there and the higher allocation, and India being the crosshairs of this administration right now, that has resulted in that significant underperformance. But again, you look over long periods of time, even with this last 12-month period, they're outperforming over the long run.
And maybe Brian, what we can do is just bring the longer-term results of these managers to our next meeting. We're going to do a deeper dive on the alts. Maybe we'll do a deeper analysis on these as well.
The other thing, Landon, too, that we looked at was over time, over sort of a long period of time, do these two portfolios, I'm just talking about GQG because they're the same firm, right? Do they tend to outperform and underperform at the same time? And there isn't a terribly high correlation between these two portfolios in terms of whether they outperform or when they outperform and when they underperform. So it's just this timing period where junk has been running and driving the price of a lot of these stocks. By the way, in the non-U.S. markets, we haven't really talked about this, but there's two sectors, two industries in particular that have driven the return. One is European banks, which pretty much nobody owns because if you're going to be in the financial sector, you're going to own the U.S. banks. Secondly, it's European defense stocks. European defense stocks are up about 70 or 80% this year. Because one of the concessions with the EU that this administration extracted was for those countries to spend more on defense. And so those stocks, again, they're up about 80% so far this year. You don't own those, it's going to be really, really tough to outperform. So again, these are, it boils down to, these are excuses, right? I mean, we're explaining things, and I don't mean to do that. This is not something that we typically do, but these are outliers. Where we would become concerned is if they were doing something that was out of character, and we don't see that. And so we want to keep those exposures. We want to hang on, because what tends to happen is when you move away from things that aren't working because you're at the point of maximum pain, is when those things start to turn, and then we don't have that exposure. And so that's kind of what we're trying to avoid. And trust me, Jim and I talk about this stuff daily, sometimes multiple times a day, and we keep coming back to the point that, look, there's nothing that they're doing here that's different than what they've done historically. We know why we've got these portfolios or these investments in the portfolio. We think they're going to pay off. Equity markets have rich valuations. It's this defensive characteristic because of all the other stuff we got in this portfolio that's really going to protect on the downside. We want to stick with it.
Okay.
Any other questions about anything here?
Nope, I think we can move on.
Okay, great. So, Stacy, are you able to pull up the other report? Jim's got his slides in that deck.
And maybe if you could open up the deck to page 5 of the main deck. Yep, this is what we forecast. So I'll run through these slides. Brian covered some of this material in his opening comments, but I want to level set with you what we're thinking today and what our forecast is. So our base case is that the U.S. will have a soft landing. I think if you would have asked us earlier in the year, depending upon how countries reacted to the tariffs and whether it was going to be retaliatory tariffs or not, this number might have been a little bit lower. But base case, 75% of a soft landing. Inflation, we think this will be higher for longer and above the Fed's 2% target. I will show you a couple of charts and graphs that support that. We have the personal consumption index at about 3.4% this year and just under 4% for 2026. We have the CPI peaking at close to 5%. And all of this also means that we will likely see an uptick in unemployment from where we're at today, which is a little around 4.2% to just under 5%. The base case for us is that the 10-year Treasury will end the year, we haven't changed this, around 4%. So currently we're around 4.25%. We think the S&P 500 trades towards 6,500 towards the end of the year, and that's been our target for a while. We're currently right around 6,300, so that leaves just a couple of percentage points of excess return between now and the end of the year. We move to the next slide, please. As Brian mentioned, first half of 2025 was a wild ride because of Liberation Day. And Brian covered this, but it's been a very unusual period when non-U.S. developed outperformed U.S. I think the last time that happened was back in 2017. U.S. has closed the gap a little bit, but the numbers generally still hold. This next slide, I think, sort of puts in perspective graphically what happened. The post-Liberation Day bear market seemed to be pretty short-lived. On April 2nd through the 4th, the market plunged at almost 12% after Trump's sweeping tariffs erased about $3 trillion of market cap. And then, just days later, when the tariffs were paused, the market vaulted about another 10% off those lows, and that was the biggest daily jump that we've seen since 2001. And interestingly, during that period, as Brian mentioned, we did have an intraday bear market in the broader indices, both the S&P and the NASDAQ. But the average stock, the drawdown in the average stock in the index was closer to 30%. The amount of equity volume traded year to date has been 6.6 trillion, and that's been a new record for the year. And then on top of this, we have the dollar having its worst year since the Nixon era in the 1970s. So the market now has deep faith that rate cuts are imminent. Inflation risks from tariffs are going to be modest to minimal. And this is causing the S&P and the NASDAQ to trade at or near new all-time highs. In terms of our earnings forecast, we think 2025 will be modest. We're forecasting something around 7% growth for this year. 2026 will be closer to 9%, and then 2027 closer to 13%. So very supportive from an earnings acceleration standpoint moving out through 2027. This next slide is just shows again that the contribution to the first half had really ultra low leadership. Two stocks, Microsoft and NVIDIA, drove almost half of the results for the first half. About 6% of the total S&P 500 gain year to date. Microsoft up 21%, NVIDIA driving another 20% of that. So the median stock is really struggling. We've talked about the effect of some of these larger Mag 7 stocks like Meta, Broadcom, Netflix. And so most money managers who don't own these stocks are really struggling this year.
So from 22/23, this line going down is just basically saying that the market cap weighted stock index is sort of dramatically outperforming the equal weighted.
Yeah. Yes. Yeah. And this is I don't have the exact calculations of this slide because I didn't prepare it, but it's median stock weighted here. So it really amplifies how well a few handful of mega cap companies are doing. And it's something we looked at last year, almost this sort of exact same effect. Next slide. One of the reasons that Morgan Stanley has had the view that rates would be on hold for 2025 is that inflation prints are still higher than what the Fed would like to see. So here we're on the right, we're looking at the super core CPI, and this is a measure of inflation that focuses on core services. It excludes the cost of food, energy, and housing. And it's one of the key metrics we think that the Fed looks at. And you can see the May number here came in at about 2.86%. The June number was printed higher than that at just under 3%, 2.9%. So, it's hard to say that inflation is under control when you've got inflation numbers like this moving up, and below that we're looking at the core CPI, which is contributions to core PCE year over year, another one of the Fed favorites, which excludes the two main categories, food and energy. That June print is 2.8%. So again, directionally not where the Fed wants to see these numbers going. And of course, we've got the uncertainty of ultimately of the tariffs, and those are most likely to start to bite here in the third and fourth quarter. The next slide sort of changed the trajectory of expectations for a Fed rate cut. And so a couple things are going on here. We're looking at unemployment, which is now at about 4.2%. I think most economists would say that is indeed full employment. We had the June payroll surprise. We had 73,000 jobs for the month, but unfortunately the May and June numbers were revised down by 258,000 jobs. So that downward revision has changed the probability of a rate cut. Probability of a September rate cut is now 93%, according to the Fed futures. And October now is at about 65%. And I think it's important to know that, yes, the payroll employment rose less than expected in July. But hours worked were at a record high, and so were wages adjusted for inflation. So it seems like what companies are doing is that they're hesitating to hire, but they're also not firing people. So all in all, it seems still like a pretty healthy underpinning, and overall unemployment is very solid still. So we tend not to get spooked by just one payroll number. I think it's on this next slide, it's healthy to just look at rates. And on the left, we have 10-year, 30-year, and 2-year Treasury yields. And what we can see here is that long rates continue to trade in this very tight range. They've been in for the better part of 18 months, and the 10-year Treasury is hovering around 4.3%. We'll look at in a few seconds that global rates have moved, but the 10-year, 2-year, 10-year, 30-year Treasury has really been locked in this pretty tight trading range, and the spread between the 2 and 10-year, continues to be pretty positive. It's just close to around 50 basis points. And this next slide is what I was referring to. If we want to look at rates more globally, we've charted the 30-year U.S. Treasury, and we've done the same for Germany, Japan, and China. And you can see they're absent China, they're all trailing up to the right. So global rates have really moved up aggressively in the last 3 to 6 months. And this is, I think, additionally anchoring a pull forward of U.S. Treasuries. The reality is that most of the rest of the developed world is probably moving towards a period of material fiscal expansion that is likely to expand their overall debt issuance at the exact same time that U.S. Treasury issuance is poised for a very significant increase as well. And I think we would be remiss if we didn't spend a minute on the next slide. And here, we're looking at the Congressional Budget Office forecast for the deficit as a share of GDP, the one big beautiful bill and tariffs. And if you look at them together as a package, it's an awful lot of spending, and it's an awful lot addition to net debt for a modest amount of stimulus. And the stimulus is very front-end loaded, and which is illustrated in this chart on 2026 and 2027. And most of the pain is on the back end. The Joint Committee on Taxation estimated that the bill would increase the deficit by around 3.8 trillion, and it never ceases to, I think, amaze both Brian and I how well the market takes this. But at some point, I don't know when, we've been doing this a long time during our careers, but the markets could rebel against this unsound fiscal practice. And this rebellion could include the wisdom of cutting taxes and increasing the fiscal deficit when the economy is already at full employment. So no economic shock, and we have these deficits. So the tools, resources, the buffer, if you will, that the Fed has is sort of diminished relative to other periods of time where the markets were in distress. But for the moment, the market seems okay with it. The last slide,
Hey, Jim, is it roughly, roughly the budget deficit is like $1 trillion and the total GDP is like 20 trillion?
yeah, I think that's roughly right. Roughly right. I think most people look at it as the deficit debt as a percentage of GDP at around 6%, and there's a slide here where I'll just speak to it, where we talk about interest payments as a percentage of the debt outstanding as a deficit, and now the interest payments are in excess of what we spend on military. So it's been a concern for investors for a long time, but for the moment, the investors continue to look past what probably is the biggest, most systemic risk for global investors, is the continued debt that we build here in the United States. So, and when the interest continues to grow over time and it looks unabated, it's sort of like a cancer. Eventually it will become a problem. But I think we're all hoping that the budget would be more aggressive towards paying down or reducing the debt over time rather than expanding it. So the last slide I'll cover is kind of an interesting slide about who's buying U.S. Treasuries, who owns U.S. Treasuries. And we're on slide 14. The next slide, please. Yeah. So you can see the largest holders: Japan, United Kingdom, China. But there's a interesting new purchaser of U.S. Treasuries, and that is stablecoin. And you may have read that the Genius Act that was recently approved by Congress establishes the first sort of comprehensive nationwide regulatory framework for payments of stablecoin, which require 100% reserve requirement for the issuer. So each stablecoin, one for one, has to be backed by either cash or liquid assets like U.S. Treasuries. And so this creates a new regulatory framework. it's early days to see what will ultimately happen with stablecoin. There are two. One is Circle. One is Tether. Circle embraces this compliance-first approach. Tether has historically adopted more of an offshore approach and has been historically less focused on the regulatory compliance. But as that asset grows, demand for U.S. Treasuries will grow because of the regulatory framework that Washington has put in place now for stablecoin. You know, 5 years ago, we would not have seen two stablecoin players in the chart showing major foreign holders of U.S. Treasury securities, which is good news because it creates another buyer for all the debt that we have to issue. So I'll stop there unless there are other questions, comments.
I'm not seeing any other or hearing any other questions in the room here, so thank you very much. Appreciate the recap and the outlook.
Welcome.
And I think we can turn it over to John Hancock.
All right.
And Perry, did you want that one first? Or
Yeah, we can go through that one first. It's the one that really is, it's kind of hard to see it there. This is the funded status reconciliation. And as Landon had requested, we went through and put it into an annual format. So instead of showing it quarter by quarter, this is for the entire fiscal year. And keep in mind that this is still based on the 2024 liability numbers. Nothing's been recalculated. It's just been rolled forward from last year's valuation. The 2025 valuation is underway, and that'll be presented at the next meeting. So that will give an update for these numbers. But as you can see, the funded status roughly in the low 70s to mid 70s, and that's been pretty consistent. There has been a bit of an improvement due to the earnings, as Brian mentioned during his presentation. The year-to-date earnings for the last couple of years has really made up for a bit of the deficit, and the cash flow numbers also take into account the supplemental payments, one back in December, and then the one that we just did here on August 1st. So, and that was $1,500 per payee. And we also, when we do that, we go through and check, because some people are in both plans, so we make sure that we only give them one of those supplemental payments as opposed to a double dip there.
Would you mind flipping to the total plan? Is that both together? Yep.
That would be the next page there, I think.
Yeah, I think that's the combined systems. So looking back to 2020, June 2023, there was a deficit of 87 million. As we sit at the end of June 25, that's down to 63, which is, the driver of that is, as Perry said, the investment return, which is a testament to, again, strong markets and also the overall investment strategy. So it's, over this time period, and I guess going back further, the strategy is working.
Mm-hmm. Yeah, I would agree.
Do you know, Are you aware at this point of going through the sort of the revaluation of any actuarial sort of assumption changes that are going to drive the liability one way or the other?
I really am the wrong person to ask about that one. I tend to be more involved on the administration side. John is the one that's more versed in the valuation.
Okay.
But it looks like this maintains the 7.25? Is that, you're talking about the rate of return?
Yes, and again, that was the rate used for the 2024 evaluation.
Actuarial changes is like mortality assumptions and like some experience. They have to adjust their assumptions based on actual experience of what's happened over the year in the plan, that kind of change. But yeah, the discount rate would be a bigger driver of change to the liability.
Yep.
This is one that's been brought up before, so that's what I was wondering.
Yeah, it was discussed, I think, meeting before last. And I think ultimately the decision was to leave it where it was, but we can revisit that again in the next meeting.
And I guess the impact of that would be the city would have to put in, the calculations would then cause the city to have to put in money faster than otherwise if you keep the 7.25. So, the gap there of the 63 million is going to have to be either filled by investment return or contributions one way or the other. If you've got a higher discount rate, it gives the investments more time to work and would hopefully reduce the city's contributions over the long term.
And Landon, when we reviewed the long-term returns earned by the plan, they've been north of 7.25. So I think, over 15, 20 years, it's sort of justifiable. And based on future capital market returns, we think it also is still justifiable. But you're right, there's only one of two ways to close the gap. It's investment returns or cash.
And the other piece of the presentation is just kind of some statistics on, the payees. Roughly 600 and something payees in the police and fire plan, and about 300 or so in the supplemental. And this right here, these are webinars that are available to the city's participants. They can go out and sign up for them. The topics vary throughout the year. The reason the one in April is crossed out is that was obviously during the volatile markets, and it was replaced with one that was more of what to do in investing in volatile markets, especially when you're a long-term investor. One that is new for us is the one in November, Navigating Medicare. And that is done by Medicare. It's not done by John Hancock, as is the one for Social Security. It's the Social Security Administration that actually does that webinar. We just are the ones that are facilitating it. And all of these are done live in both English and Spanish, and they are recorded. And the only exception to that is the one for the Social Security. That one, the Social Security Administration does not allow us to record it. But to make up for that, instead of just having a couple of sessions, we put in 6 or 8 just to give enough room for everyone to be able to sign up. And that is by far our most attended webinar all year. All right. And then, the other statistics, I don't think we need to go through them here. You can review them at your leisure.
How are those plan seminars marketed to the members?
There is
On a regular basis?
Yes, there's a newsletter that goes out to anyone we have an email address for.
Okay.
And there are links to be able to sign up for the webinars. There's also, other participant-facing materials that we have, encouraging them to do things like name a beneficiary, other things like that. And so those go out generally on a monthly basis to the participants.
So they're touched by John Hancock on a fairly regular basis.
Absolutely.
Okay.
All right, and so yeah, that's just kind of a snapshot there, the number of participants. And then there's, as far as still active employees, there's, I think, 1 for the fire and police, and then there's still 6 in the supplemental. They're still actively working. All right.
Question real quick.
Mhm.
Actively working or actively working for the city?
Actively working for the city. All right. So with that, I'll give everyone the rest of their time back.
Okay. Thank you. Any other questions, comments, concerns before we adjourn?
No.
Okay, with that, meeting adjourned.